What's going on, guys? It's Christian from Stock Hours. In today's video, I'm going to talk about one of the most popular trading indicators, and that is moving averages. So the first thing that I want to mention about moving averages is that they're not all the same. So you might have an SMA or an EMA. So basically, the difference between the two, an SMA shows you the average of the last X amount of candles. Let's say you have the 8 SMA, so the 8 simple moving average. It's going to just show you the average of the last 8 candles, with every candle having an equal weight. But now if you have the 8 EMA, it's going to show you the exponential moving average. So the most recent candles are going to have more weight in that calculation. So basically the SMA is less responsive to quick volatile moves than the EMA might be. So if the EMA, the most recent candle, had a very big jump up, then the EMA is gonna move up quicker than the SMA will, since the SMA, the simple moving average, is just calculating whatever the average is of the last X amount of candles, the close of those candles. The EMA is going to have more weight, like I said, in the most recent candles. So, in my opinion, the EMA is better for, breakout trading, just because it'll be closer to where the actual bigger moves are going to be and the more recent moves. So it's less delayed. However, almost every indicator in the stock market is all going to be delayed other than just raw price action. So it's one thing that you guys should keep in mind when using pretty much any of these indicators. So the next point about moving averages is going to be the length. So for example, if you guys look at my screen, I have a green moving average, a yellow, and a red. So the green is going to be the closest to where the candlesticks are trading at. The yellow is a little bit farther, and then the red is going to be the farthest. There actually is a blue one, which is even farther than the rest of those. So when you're actually inputting moving averages to your chart, you're going to set a length. So the green one is going to be the shortest length. So it's going to calculate based off of the least amount of candles. Yellow calculates based off of more. Red would be the highest. So when you're looking for shorter moves, so for example, short breakouts, you might want to keep in mind the shorter length moving averages. So for example, on this, we're on the 1 minute chart. So on this move up on Nvidia today, you might have waited for a retest of a shorter moving average to take a quick scalp, breaking through high of day or something like that, for example. So you might have taken it here, targeting this 906 key level, or you might have waited and then taken it at 906, targeting 910 or even 912, for example. So for example, the 8 moving average is just going to look at the 8 prior candles. Again, if it's the SMA, it's just going to look at the close of the last 8 candles, find the average, and then that's going to be your area. If it's the 8 EMA, there's going to be more weight in the more recent candles. So for example, on this big green candle, it's going to make the 8 EMA move up stronger than the 8 SMA, just for example. Now the next point I want to go into with moving averages is the time frame that you have open. So since I'm on the 1 minute chart right now, it's only going to look at the last 8 bars. So whatever time frame it is, it's going to calculate based off of the last 8 bars on this time frame. So for example, at 9:45, so right here, my shorter EMA is at 9:03.66. But if I move to the 15 minute, it's going to be at a much different value because it's calculating based off of different data. So it's still looking at the last 8 bars, but since I'm on a 15 minute, it's looking at the last however many bars in this 15 minute chart. So at 9:45, it's at 900 versus almost 904. So since it's calculating based off of different data, then it's going to be at different values. And even if I went to, for example, the daily chart, it's still going to show even more variance of data. So this is at 870. So looking at your different time frames to see where the SMA or the EMA is going to show you different information. So based off of your trading strategy, you might want to look at different things. Since I generally scout for the most part, I might just look at the 1 minute to see for these quick 1 minute pullbacks, retests of a moving average, and then potentially play continuation through those levels. And then to the next point, which I kind of just touched on, is a scenario where you might want to use moving averages to actually take trades or use as conviction for a trade you're already looking to take is when you're approaching a level but you're too overextended. So in a situation like that, you might not want to take the trade here, for example. You might want to wait for it to pull back, test one of these moving averages. If it holds, it's going to show you that it's generally strong, and then if it starts to break out again, then you might want to take your breakout there, knowing that we had a healthy pullback and then potentially going for more continuation in your direction. But in examples like this where it might be too extended, the stock might be due for a pullback. So even though here it was just flat to the time it hit this moving average, there are going to be times where it pulls back, tests this, and then moves up, or it pulls back, tests it, and then doesn't hold, and then will continue to either consolidate or move down. So waiting for the test of a moving average or a test of a key level or something like that might be good conviction, and then when it starts to hold that level and then move back up, to see that your stock, whether it's buyers or sellers, are reacting the right way at certain key levels or certain indicators. So the next thing I see a lot of people use with moving averages is something I don't personally agree with, but it is something to kind of keep in mind and think about the actual principles about what's happening. And that is in a moving average crossover. So you can see over here, you have your shorter moving average, so this green one starts to cross under and below the yellow and red ones. So what that's telling you is the shorter term trend is starting to cut below what our bigger trend is showing us. So for example, the red would be our bigger trend, since it's calculating off of more data, more bars of information, versus the green one is calculating less. So for example, I think this is an 8 and then a 21. So when our 8 is cutting below and under our 21 moving average, that's showing you that in the short term we're starting to pull back. So something that people use pretty blindly, and I don't necessarily agree with, is that when they see a crossover of a moving average, they'll just jump directly into puts. So something like that, in my opinion, is not a good strategy of trading. It's something you'd have to go back and back test the validity and the profitability of a strategy like that. And it's if you actually were to back test it, it's usually not that profitable of a strategy. So that's just one misconception in the market that a lot of people have. They think, whenever you get a moving average crossover, the stock's going to reverse and maybe hit low of day or something like that. So if you look at this example, it doesn't break down and start downtrending. What we got was chop for a little bit. So when we started crossing over to the downside, we just chopped around for 10 o'clock to 11 o'clock. So basically like an hour and a half. It just started being flat. So the good thing about noticing in that situation is that the aggressive trend might be over. So if you're in calls from this area and you're just holding to wait to see when the immediate move is going to end or slow down, then you might see a moving average crossover and see that, okay, the aggressiveness of buyers has gone down a lot, so I might want to get out of my position here, knowing it could pull back or it could just chop around for a little bit. So that's one way to look at it. I still think if you are trading based off of raw price action, that's going to be your best edge. But it is one thing to consider. if you are just looking at trading these moving average crossovers, that you would have to backtest it to see if it's actually a valid strategy and it's going to make you money in the long term. So the next important thing to know about using a moving average in your trading, or any indicator really, is that you should only use it for confirmation of trades you're already looking to take. Don't just blindly see, okay, we're holding a moving average and we're starting to move up, so let me just get in a trade there. Use it in situations where you're gonna take the trade in that area anyway, and you're seeing that we're holding a key indicator or a key level or something like that. One of the big reasons why you shouldn't use a moving average blindly and on its own is because it's a delayed indicator. The only reason moving averages update is based off of past information. So if you're trading, especially as a scalper, if you're only trading based off of past information, you're always going to be late to the trade. But if you're looking at raw live price action and using, for example, a moving average as confirmation and conviction for your trade, then it can help you. But if you're just blindly looking at delayed indicators, you're going to get into your trade late almost every single time, and it's not going to help you get the most precise entries and exits in your trading. So these are my thoughts about moving averages and how you can use it effectively in your trading, especially as a scalper. Let me know in the comments below if you use moving averages in your trading and how it's gone for you. If you liked the video, make sure you leave a like below. I'll see you guys soon. Peace.